there, accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 10, Liabilities, Current Installment Notes, and Contingencies from Warren, Jones, and Taylor, Financial and Managerial Accounting. So as we know, buying goods on credit, it's essential for businesses and it's also essential for individuals. But one of the key things is that you need to ensure that these liabilities, these obligations are correctly tracked. So whenever a company or a bank, they advance credit, they're in essence making a loan. The company or the bank is called the creditor or the lender, and the individual or the companies that are receiving the loans are called the debtors or the borrowers. So debt, generally, it's recorded as a liability by the debtor. And we have what's called long-term liabilities, and we have what's called current liabilities. So our long-term liabilities that are debts that are due beyond 1 year. So for example, a 30-year mortgage used to purchase a property, that would be considered a long-term liability versus current liabilities, which are debts that'll be paid out of current assets and are due within 1 year. So some great examples of current liabilities would be accounts payable and accruals, short-term notes payable, and any current portion of long-term debt. So accounts payable transactions, they're described and best illustrated simply by the wording in and of itself. Payable. There's an account that is payable, so therefore there's a liability and obligation to pay for something. So accounts payable transactions involve a variety of purchases on account, including the purchase of merchandise and supplies. Accrued liabilities reflect an obligation to pay current assets in the future. Accrued liabilities are normally recorded at the end of an accounting period as part of the adjustment process. So we know that there's what's called accrual, and there are deferrals that need to be taken care of during the adjustment process. So we record all of our transactions within the accounting cycle. We post them to their respective accounts. And then from there, we prepare an unadjusted trial balance. This is the step before we can even issue the financial statements. We might have started off the beginning of the period with $500 worth of supplies. At the end of the period, it's more than likely that that's not the same balance that we have at the end of the period. Likewise, we might have incurred expenses that have not yet been paid, and these are accrued liabilities. We record the expense, and then we record the payable. This could be for utilities. It can also be for wages and salaries to employees. So these things need to be recorded. So for most companies, accounts payable and accrued liabilities represent the largest portion of current liabilities. So with short-term notes payable, notes may be issued to purchase merchandise or other assets. Notes may also be issued to creditors to satisfy an accounts payable that was created earlier. Each note transaction affects a debtor, which is the borrower, and a creditor, which is the lender. And a company may also borrow from a bank by issuing a note. So here we have an example. It says on May 1st, Bowden Company purchased merchandise on account from Coker Company, $10,000, net $30. The merchandise cost Coker $7,500. So we see it from both the perspective of the borrower, the debtor, as well as the creditor, the lender. So for Bowden, they now have $10,000 worth of inventory. So the journal entry is to debit inventory for $10,000 to increase the asset, and to credit accounts payable to increase our liability. Now on the creditor side, they debit accounts receivable. They are expecting to receive $10,000 in the future. So they debit their asset account, and they credit sales, the revenue account, to show the increase of $10,000. In addition, they also need to record the cost of goods sold. So they debit cost of goods sold, the expense account, to increase the value, and they credit the inventory account to show the decrease in value because the inventory is now sold. So this is on May 1st. Now, May 31st, it says Bowden Company issued a 60-day 12% note for $10,000 to Coker Company on account. So in this case, we record the note. We debit our accounts payable for $10,000 and we credit the notes payable. So what this simply does is that we shift the account payable and it now becomes a note payable. So in this case, we also see the shift for the creditor. We debit the notes receivable and we credit our accounts receivable. So we are essentially shifting what happened in the first account, or the first transaction rather. We set up the liability and now we're reducing the liability and we're creating a different type of liability, a notes payable. The same thing for Coker. Initially, they set up an accounts receivable, and now we are shifting it from a accounts receivable to a notes receivable. And now for the last transaction, it says Bowden Company paid Coker Company the amount due on the note of May 31st. So there's interest. It lets us know that it's a 12% note and they have it for 60 days. So in order for us to calculate the interest, it's as follows: the face value of the note multiplied by the interest rate multiplied by 60 divided by 360. So keep in mind, we can't simply multiply it by 12% because 12% represents interest for the entire year. But we see that this is a 60-day note, hence why we divide 60 by 360. So we debit our notes payable to fully take care of the liability. However, on top of the $10,000 that was borrowed, we also have to pay interest of $200. So therefore, we credit our cash for a total of $10,200. $10,000 to take care of our face amount of the loan, the principal, plus $200 of interest expense. Now on the creditor's end, they debit cash. There's an increase of cash of $10,200. They earned $200 worth of interest revenue, and then they credit notes receivable for $10,000. So in some cases, a discounted note may be issued rather than an interest-bearing note. So a discounted note has the following characteristics. The interest rate of the note is called the discount rate. The amount of interest on the note is called the discount, and it is computed by multiplying the discount rate times the face amount of the note. The debtor, the borrower, receives the face amount of the note less the discount, that is called the proceeds. The debtor must repay the face amount of the note on the due date. So we have current portions of long-term debt. So as we discussed earlier, there's long-term debt, but obviously we're paying it up within a number of times. So the current portion of long-term debt represents the portion that needs to be paid within the year. So the current portions of long-term debt, such as the current portion of installment notes, are reported on the balance sheet as a current liability. An installment note is a debt that requires the borrower to make equal periodic payments to the lender for the term of the note. So the term of the note might be for a year, might be 3 years, 5 years, however long it is. Installment notes, they're often used to purchase property, so like a mortgage, plant, and equipment. So next we have payroll liabilities. All right, so as we can see, there's a lot of different liabilities that a company might be obliged to take care of. And one of the biggest is payroll liabilities. So in accounting, payroll refers to the amounts paid to employees for services they provided during the period. A company's payroll is important for the following reasons. One, payroll and related payroll taxes significantly affect net income of most companies. Payroll is subjected to federal and state regulations. Good employee morale requires payroll to be paid timely and accurately. Imagine if you're working for a company and you're supposed to get paid every Friday and they fail to pay you for 2 Fridays. More than likely, you're either going to leave the company, sue the company. So it's very important for a company to make sure they are accurately tracking how much they owe employees, especially too, because federal taxes, state taxes are being withheld. Imagine you receive a W-2. It says that $1,000 was withheld for federal income tax purposes. You file your tax return and your tax return is rejected because yes, your employer withheld the federal income taxes, but they did not remit it to the federal government. They did not send it to the federal government. So it's very important for companies to have a good payroll system and process. It affects not just the company, but the employees as well. So salary usually refers to payments for managerial and administrative staff, services. Salary is normally expressed in terms of a month or even a year. Wages usually refer to payment for employee manual labor, and the rate of wages is normally stated on an hourly or weekly basis. The salary or wage of an employee may be increased by bonuses, maybe there's commission, profit sharing, or cost of living adjustments. So any companies that are engaged in interstate commerce, they must follow the Fair Labor Standards Act. And this act, sometimes it's called the Federal Wage and Hour Law. And this requires employees to pay a minimum rate of 1.5 times the regular rate for all hours that are worked in excess of 40 hours per week. So there are some exemptions that are provided for anyone in a position of an executive, administrative, and some supervisory positions. Increased rates for working overtime, nights, or holidays are common, even when it's not required by law. And sometimes the rate might be twice as much as regular time because, again, you want to be able to, retain employees. You want to be able to give them an incentive to work hard. So companies sometimes, even though it's not required, they'll, offer that extra rate for working overtime, nights, or holidays. So the total earnings of an employee for a payroll period, including any overtime pay, these are called gross pay. So from this amount is subtracted one or more deductions to arrive at net pay. So net pay is the amount that's actually paid to the employee. These deductions normally include federal income taxes, state income taxes, local income taxes, medical insurance, and pension contributions. So employers, they're normally required to withhold a portion of an employee's earnings for payments of the employee's federal income tax and also state income tax, depending on which state the individual lives in. So each employee authorizes the amount to be withheld by completing what's called a Form W-4. And Form W-4 is the employee's withholding allowance certificate. On the Form W-4, the employee indicates their marital status and the number of withholding allowances, right? So each dependent reduces the federal income tax withheld from the employer's pay. There's some other factors. Let's just say maybe they might have other income, if they have a second job, if they have interest income and other deductions, as well as any other extra withholdings may also be reported on the form. So the federal income tax withheld, it ultimately depends on each employee's gross pay and W-4 allowance. And the withholding tables issued by the Internal Revenue Service, the IRS, are used to determine the amounts to withhold. So oftentimes what happens, persons, they will file their tax return, and especially in situations where they have a balance due, they're confused, they're upset, they're saying, I'm paying all of this money in taxes and I still have a balance due. Ultimately, what happens is that persons, they don't realize that, okay, $500 was taken out of your check. Only $150 of that went to the federal. The remaining $350 went to Social Security and Medicare taxes. Maybe it went to state taxes. Maybe it went to insurance and things of that nature. So it's very important for individuals to understand the implications of how you complete your Form W-4 and the impact that it has when you file your federal income tax return. So we have these FICA taxes. And under FICA taxes, there's an act called the Federal Insurance Contributions Act. So employees are required by this act to withhold a portion of the earnings of each employee. The FICA tax withheld contributes to two federal programs. The first is Social Security, which provides payments for retirees, survivors, and disability insurance. And then we have Medicare, which provides health insurance for senior citizens. The amount that's withheld from each employee is based on the employee's earnings that are paid in a calendar year. And we know a calendar year is from January 1st to December 31st. The withholding rates and maximum earnings subject to tax are often revised by Congress. So as it relates to Social Security is essentially 6% on all earnings, and Medicare is 1.5% on all earnings. And this is, just to make it easy. These are not the correct rates that are used at the moment, right? But this is just for an example. The correct rate is 6.2% for Social Security, and it is 1.45% for Medicare. So I just want to make sure that you understand this, as it states here, is to simplify. The chapter assumes the following rates, but in all reality, Social Security is 6.2%, and it is paid by both the employee and the employer, and Medicare is 1.45%, and it is paid by both the employee and the employer. So some other deductions: employees may choose to have additional amounts deducted from their gross pay, such as deductions for retirement savings, charitable contributions, as well as life insurance. So when it comes to computing the employee's pay, gross earnings less payroll deductions equals net pay, and sometimes it's called the take-home pay. So after all deductions are accounted for, whatever is left, that's what you take home. So as mentioned earlier, employers, they're also subject to payroll taxes for the amount that's paid to their employees. So oftentimes, this is why certain companies, they would prefer to have people paid as an independent contractor versus being paid as an employee, because all employees are required to be put on payroll. And whenever an employee is on payroll, the employer is also required to pay payroll tax, right? So it's very important for employers to distinguish between who is truly an employee versus an employer. And reason being, there are some very hefty fines if a company does not classify a worker correctly, just for the purposes of avoiding payroll taxes. So employees are subject to the following taxes for amounts paid to their employees. There's FICA tax. Employers must match the employee's FICA tax contribution. Federal unemployment compensation tax, FUTA. This employer tax provides for temporary payments to those who become unemployed. SUTA, state unemployment compensation tax. This employer tax provides temporary payments to those who become unemployed. So there are certain taxes that need to be paid by both the employee and the employer, and there are certain taxes that are only paid by the employer. So FICA tax is an example of a tax that's paid by both the employee and employer, and FUTA and SUTA taxes are paid only by the employer. So when it comes to recording payroll liabilities are normally recorded at the end of each payroll period. Employers must match the employee's Social Security and Medicare taxes, as mentioned. And in addition, the employer must pay state and federal unemployment compensation taxes. So now for paying payroll, companies, they pay employees either by electronic funds transfer, so when you get a direct deposit, or they issue payroll checks. So with electronic funds transfers, the employee's net pay is electronically deposited into their bank account each period. The employees receive a payroll statement summarizing how the net pay was computed. Most companies use a special bank account for payroll. An advantage of using a separate payroll bank account is that reconciling the bank statements is simplified. So some examples of payroll controls include the following: Hiring and firing of employees should be properly authorized and approved in writing. All changes in pay rates should be properly authorized and approved in writing. Employees should be observed when arriving for work to verify that employees are checking in for work only once and also only for themselves. Employees may check in for work by using a time card or by swiping their employee ID card, and a special payroll bank account should be used. So fringe benefits. A lot of companies, they provide their employees with benefits in addition to salary and wages earned. So these are referred to as fringe benefits. This might include vacation, medical, and retirement benefits. The cost of employee fringe benefits is recorded as an expense by the employer. And so in order to match revenues and expenses, the estimated cost of fringe benefits is recorded as an expense during the period in which the employees actually earned the benefit. So one is vacation pay. Most employers, they provide employees vacation, sometimes called compensated absences. The liability to pay for employee vacations could be accrued as a liability at the end of each pay period. However, many companies, they wait and they record an adjusting entry for accrued vacation at the end of the year. If employees are required to take all their vacation time within 1 year, then the vacation pay payable is reported as a current liability on the balance sheet. If the employees are allowed to accumulate their vacation pay, so if they can transfer it from year to year, then the estimated vacation pay payable that will not be taken within a year is reported as a long-term liability. So when employees take vacation, the liability for vacation pay is decreased by debiting vacation pay payable, salaries or wages payable, and the other related payroll accounts for taxes and withholdings are then credited. Next, we have pensions. Pension is a cash payment to retired employees. Pension rights are accrued by employees as they work based on the employer's pension plan. Two basic types of pension plans are defined contribution and defined benefit plans. So under a defined contribution plan, the company invests contributions on behalf of the employee during the employee's working years. So normally the employee and the employer, they both contribute to the plan. The employee's pension depends on the total contributions and the investment's return that's earned on the contribution. So one of the more popular defined contribution plans is a 401k. Most people hear that term often, a 401k. So under this plan, employees contribute a portion of their gross pay to investments such as mutual funds, stocks, bonds, etc. And a 401k plan offers employees two advantages. First, the employee contribution is deducted before taxes. Two, the contributions and related earnings are not taxed until it's withdrawn at retirement. So for some persons, this is a cost-saving strategy or a tax-saving strategy rather. Right now, maybe the individual is making $100,000 and they anticipate that in their retirement, that'll be cut in half. Maybe they'll make $50,000 or $40,000, right? So as they're thinking in longevity, right now their tax bracket is higher. So therefore, it makes more sense for them to utilize a defined contribution plan. So that way, when they get to retirement, the amount of tax that they will pay on the amount will not be as much. So in most cases, the employer matches some portion of the employee's contribution, and the employer's cost is debited to pension expense. Next, we have defined benefit plans. In a defined benefit plan, the company pays the employee a fixed annual pension based on a formula. The formula is normally based on such factors as the employee's years of service, their age, and past salary. In a defined benefit plan, the employer is obligated to pay for, they are required to fund the employee's future pension benefits. And as a result, many companies, they're replacing their defined benefit plans with defined contribution plans. So the pension cost of a defined benefit plan, it's debited to pension expense, and cash is credited for the amount contributed, funded by the employer. And any unfunded amount is credited to an account called unfunded pension liability. If the unfunded pension liability is to be paid within 1 year, then it's reported as a current liability on the balance sheet. And any portion of the unfunded pension liability that is going to be paid beyond 1 year is a long-term liability. So employees, they may earn rights to other post-retirement benefits from their employer. So such benefits might include dental care, eye care, medical care, life insurance, tuition assistance, tax services, legal services. So in order to account for these other post-retirement benefits, just keep in mind that it's similar to that of a defined benefit pension. The estimate of the annual benefits expense is recorded by debiting post-retirement benefits expense. And if the benefits are fully funded, cash is credited for the same amount. And if the benefits are not fully funded, a post-retirement benefits plan liability account is also credited. The financial statements should disclose the nature of these post-retirement benefit liabilities because creditors need to know the impact. These disclosures are usually included as notes to the financial statements, and additional accounting and disclosures for post-retirement benefits, as mentioned, are required to be distinguished in these notes because, as we know, in the event that, God forbid, a business files for bankruptcy or liquidates, the creditors are taken care of first before the shareholders, the owners. So next we have installment notes. An installment note is a debt that requires the borrower to make equal periodic payments to the lender for the term of a note. Each note payment includes payment of a portion of the amount initially borrowed. This is referred to as the principal or the face value, in addition to payment of interest on the outstanding balance. So at the end of the note's term, the principal would have been paid in full, and then there would also be interest paid on top. So installment notes are often used to purchase specific assets such as equipment, and they're often secured by the purchased asset. So in such case, in the event that the borrower fails to pay the note, the lender now has the right to come and take that property, right? The possession of the pledged asset, and then they can sell it to pay the debt. So installment notes that are secured by purchased assets are sometimes called mortgage notes. So when an installment note is issued, a specific journal entry must be recorded. The individual would debit cash and credit the notes payable, assuming cash was received, setting up this liability. Next, for our periodic payments. So the preceding notes payable requires Lewis Company to repay the principal. All right, each installment note includes an interest and principal component. So in the textbook, we use the example of Lewis Company, and this is for all companies, all corporations on the whole, when they have periodic payments. Each installment note payment, as we pointed out, includes an interest and principal component. The interest portion of an installment note payable is computed by multiplying the interest rate by the carrying amount, which is referred to as the book value of the note at the beginning of the period. The principal portion of the payment is then computed as the difference between the total installment note payment, the cash paid, and the interest component. After the final payment, the carrying amount of the note should be zero, indicating that the note has been paid in full. Next, we have what's called contingent liabilities. So some liabilities, they may arise from past transactions only if certain events occur in the future. So these potential quote unquote obligations, these are called contingent liabilities. So the accounting for contingent liabilities depends on the following two factors. One, what is the likelihood of this occurring? And the likelihood of occurring is classified as probable. reasonably possible or remote, and measurement. The ability to measure the potential liability is classified as estimable or not estimable. So now we need to distinguish probable and estimable. So if a contingent liability is probable and the amount of liability can reasonably be estimated, it is recorded and disclosed. The liability is recorded by debiting an expense and crediting a liability. If the product is repaired under warranty, then the repair costs are recorded by debiting your product warranty payable, decreasing that liability, and crediting cash, supplies, wages payable, or other appropriate accounts. If a contingent liability is probable but not estimable, then a contingent liability, this occurrence is probable but not estimable. It's disclosed in the notes to the financial statement. So for example, let's say a company, maybe they accidentally polluted a local river. They dumped waste products. So at the end of the period, the cost of the cleanup and any fines, they can't really estimate how much it's going to cost. So therefore, they make a disclosure in the notes to the financial statements. If the contingent liability is reasonably possible, so a contingent liability whose occurrence is reasonably possible, it's disclosed in the notes to the financial statements. So for example, a company, they may have lost a lawsuit, right? They infringed on another company's patent rights, but the verdict is under appeal and the company lawyers, they think that the verdict will be reversed or maybe the fee will be reduced. So in this case, the contingent liability, it needs to be disclosed in the financial statement. Or in such cases, it might be remote. So a contingent liability may be remote. So for example, let's say there's a ski resort. They might be sued for injuries that are incurred by skiers. But in most cases, courts, they find that the skier accepts the risk. So when you go to certain places, if you go to a trampoline park, you go ice skate, in certain places, they require you to fill out a waiver, basically waiving all liability of the company. So in such case, the skier, they know the risk when they're participating in the accident. So unless the ski resort is grossly negligent, the resort is not going to incur the liability for any ski injury. So in such cases, there's no disclosure that needs to be made in the notes to financial statements. So here we have an exhibit. And in this exhibit, this essentially shows the accounting treatment for the contingent liabilities as we just discussed. So with this contingent liability, is it probable? Is it reasonably possible? Or is it remote? If it's probable, then is it estimable or is it not estimable? If it is estimable, then we record and we disclose the liability. If it's not estimable, then we disclose the liability in the notes to financial statements. If it's reasonably possible, we only have to disclose the liability. We do not need to record it in the financial statements. And if it's a remote possibility, then we do not need to do anything. So as it relates to reporting liabilities, we covered a few: accounts payable, accruals, notes payable, the current portion of installment notes payable, and any other debts that are due within 1 year. They must be reported on the balance sheet as a current liability. And any remaining installment notes payable or any other debts, they are reported as long-term liabilities. So it's important to distinguish between the two. And we'll see on the next slide why distinguishing between our current liabilities and long-term liabilities is essential. So analysis for decision-making, we have what's called the quick ratio. So we do a short-term liquidity analysis. The current position analysis helps creditors evaluate a company's ability to pay its current liabilities. So this analysis is based on the following 3 measures. We have what's called working capital, current ratio, and quick ratio. Working capital is computed as follows. It's a subtraction. We subtract current liabilities from current assets. So our working capital is current assets minus current liabilities. The current ratio is current assets divided by current liabilities. So while these two measures, they can be used to weigh a company's ability to pay its current liabilities, they do not show the company's ability to pay these liabilities within a short period of time. Reason being, some current assets, such as inventory, they can't be converted into cash as quickly as other current assets, such as cash and accounts receivable. All right. And reason being, imagine inventory, right? We sell inventory, but maybe the customer purchased it on credit. So now we need to wait for the customer to actually pay us. So that is why we have this last measure, which is the quick ratio. So the quick ratio overcomes this limitation by measuring the instant debt paying ability of a company, and it is computed as follows. Quick assets divided by current liabilities. So our quick assets are cash and other current assets that can be easily converted into cash. So that is the definition of liquidity. Liquidity is how fast an asset can be turned into cash. So quick assets, as mentioned, how easily they can be converted into cash. This is such as temporary investments and accounts receivable. Temporary investments includes marketable securities that can be easily sold and turned into cash. And the other current assets are not included as a part of quick assets because they often include prepaid expenses or other deferred assets that are not easily converted to cash. So with this quick ratio, the current and quick ratios are particularly useful in making comparisons across companies and across industries. So this brings us to the end of chapter 10, which covers liabilities, current liabilities, installment notes, and contingencies.